Nirav Sheth, a very special voice, head of institutional equities at SBICAP Securities, joins us right now on the show. Nirav, good morning. Thanks so much for joining in.
Thank you.
A big picture view first. We've all been thinking about what is it, or if there is something that could puncture the economic buoyancy across the world and maybe India too. Now let's assume that the seeds of this trade war that have been sown, if it does escalate, is that one key thing that could, not derail, but slightly deflate the economic expansion that we were all thinking will happen in 2018, a rising tide which will carry all boats along with it?
Right. So it is a risk, but I still believe it's a very low probability risk. So if you look at from the time what Mr. Trump announced in terms of levying the tariff without, essentially covering all the countries, including the allies, to the fact that if you look at what has happened yesterday in terms of watering down and keeping Mexico and Canada, that means that it seems to be more of a bargaining tool for the upcoming NAFTA talks that they're going to have. I think that there are a lot of checks and balances over there. It's highly unlikely that you'll get to a situation that you're going to go to a full trade war. The risk is there, but I don't think it's a very high probability risk.
So this has also left the room open for negotiation by different countries, because you've already exempted 2 countries.
Absolutely. Now just look at it. The moment you say that you're keeping some other countries aside, that means that the price essentially gets determined by the lowest marginal cost supplier. So it's quite likely that you may not necessarily get what you're looking for in terms of increasing the steel production in the country, because instead of China dumping over there, it's probably just Canada or Mexico will supply that. So I don't think that it changes the nature of the game.
Having said that, the mood of the market hasn't exactly been great of late either, Nirav. So what is it that is plaguing it? Is it just the fear of valuations, or money on the global level just taking a bit of a sidestep from investing into emerging market equities? What is it?
So I think that at least the way I look at it is, first of all, the narrative changed when the bond yields started moving up, right? And bond yields have always moved up, in a sense that if you look at the last 5 years and if you look at the moment, they've moved about 150 basis points. But like we say in stock market, it does not matter till it matters. It started mattering right now. The way I look at it, I think that narrative slightly falls because it's a bit technical right now. But the fact of the matter is that your valuations are a product of your required rate of return and your growth rates. So as long as my growth rates are moving up and my bond yields are moving up, bond yields are merely reflecting your higher real growth rate. They are not constraining that growth. That extent, I think the valuation should be neutral to increase in bond yields. And I think that is probably what is happening. I think once you are done with this absorbing the new incremental information in the market, I think you will probably see a period of more stability, less volatility, something like that. I think the growth is very, very strong. I mean, just look at it. For example, I think yesterday the ECB president talked about the fact that they removed a key clause in their monetary policy which says that we'll increase the quantitative easing if the economic momentum doesn't pick up to desired levels. That means that you are far more optimistic in terms of how growth is going to play up. The PMI numbers over there are blowing out. Japan seems to be doing very well. The nature of the growth is such that the momentum tends to continue for a while, right? You need real big negative, something has to happen to try and puncture that growth. Unlikely.
What about India's growth story then? Because so far, the one concern which was being highlighted was credit offtake. With this recent fiasco of PNB fraud, do you think that's going to get impacted again?
There is a scope. See, I think PNB is just one part. I think that I'm increasingly disappointed with the fact that you got a lot of problems around trying to forecast the earnings, because you got business cycles, you got competitive risk. Now you got regulatory risk. And it started with LTCG, and therefore investors have to realign the required rate of returns from the markets. And now the change in RBI dispensation norms. I think even the sequencing doesn't seem to be right. What you want to do, you do it upright and then say that now I go and capitalize the banks. You want to capitalize the bank, the stock price moves up, then you say that I'm going to change the RBI dispensation norms, then the PNB happens. I have no idea in terms of what's going to happen to the earnings of the companies. And bank earnings is going to power about 40-50% growth of Nifty earnings, right? So that is, I think, what is probably impacting the markets. Interestingly, if you look at what RBI has done, if I look at my cumulative earnings for FY18 and FY19, I don't think there any change. What seems to be happening is that what the analysts were providing in FY19, everything gets preponed to last. So I presume that now quarter 4 will be a washout. But you are going to upgrade the FY19 earnings. So which is why markets have corrected. I'll be very surprised if you fall from the level that we are there currently.
Why do you think quarter 4 will be a washout?
Because you got all these things being preponed, right? I'm saying if you're changing the dispensation norms, then you are accreting everything to GNP at the same point of time, and the provision therefore falls in one quarter instead of being spread out over the next 4 quarters.
But that's only for the banks, you're saying?
Yes, for the banks.
Okay.
And that too largely for the PSU banks, right? I mean, or would you presume
Everyone.
that? Yeah, but retail-facing private banks will not have as big an impact, right? Or would they?
No, retail-facing, but I'm fact of the matter is that you're basically talking about the larger ones, ICICI, Axis Bank, State Bank, those that power the Nifty earnings. The bulk of their slippages are coming from corporate books, so they are not immune to that. So it doesn't impact my earnings for FY19. It does impact my earnings for FY18.
Will markets start thinking of quarter 4 earnings? I mean, I saw some mention of it, by the way, in quarter 3 as well, that Nifty earnings ex PSU banks have been this, and therefore we are hopeful of this earnings recovery continuing. Would the same dialogue and the narrative and maybe the thought process into investors' mind come in as well, that these were 1 or 2 individual events which passed by? Let's look at FY19 afresh.
Of course, so I completely agree that there is only so much weightage that you will give to quarter 4 earnings. That's a very small part of the intrinsic value of the company's earnings that you look at over a long period of time. But I don't think it's right to say that I'll only look at ex-PSU banks earnings, then I'll say I'll only look at ex-PSU banks performance, which is obviously very great because then I'm buying Kotak's and HDFC banks of the world. But my Nifty is a culmination of everything, many things else.
It does reset the base for sure.
Absolutely, 100%.
What about IT, the lone outperformer, I would call it, for 2018? Is there still value left there?
We are not very bullish on IT.
Why?
See, there is a structural moderation in the growth that has happened over there, right? So, fact of the matter is that now at margin, these stocks seem to be trading off the view on the earnings that is driven essentially by currency outlook, right? So, you had currency depreciating, and therefore that obviously propels my earnings. But if you look at what has happened in the last 3 years, you've consistently moderated the revenue. We are just looking at the dollar revenue growth rates and come down from whatever 13% to 11% to now about 8%. At 8% dollar growth rate, if I assume that earnings, if I assume that currency is not going to depreciate, then probably the earnings will grow in the region of 5 or 6% over the longer period of time, right? So let us appreciate the fact that in the last 10-15 years, a lot of their earnings got boosted because implicit depreciation of rupee by 5%. That doesn't happen, then earnings growth are very, very subpar, and in that case, your valuation 14-15 times are all that you got.
Actually 20 times in a lot of mid-cap IT companies, in 3 or 4 at least, if not more.
Absolutely.
I mean, yeah, so I was very scared when I wrote that piece about mid-cap IT valuations when the stocks were moving up. But I mean, just the point where I agree with Nirav is, I can't fathom why is it that people would pay 20, 22, 23 times for an earnings growth of 10-11% and the visibility that you have only for FY19. I don't think anybody has visibility for FY20 of what happened to IT.
Right. Yeah. I think if you ask me, these guys have wasted the opportunity they had over the last decade or so. You had 25, 30, 40 multiples. You could have just gone and acquired companies with IPR. That is how you make changes to the business model. Business was very easy to come by, labor arbitrage, 30%, 40% ROC, and suddenly you're facing these problems. And I think, and it's difficult to compound $40-50 billion market caps if you don't take these inorganic bets.
Yes, so a pocket that you had a very interesting view when we spoke. I mean, not the last interaction, but the interaction before that was aviation.
Right.
You know, moats around the business, so on and so forth. Now there is news flow suddenly of both two of the large players making a fresh fray for newer planes to come in as well. Growth numbers seem to be okay. Are investments in stocks okay as well?
Yeah, growth numbers are flying. So if you look at the January figures, traffic growth was 20% on the back of 20% growth last January, right? So they're actually outperforming even my expectations because we assumed that there would have been some moderation because I don't know if you fly often, you'll figure out what the ticket prices are, right? So they've really taken all the price increases and passed on the increasing crude oil prices. It simply doesn't have, it's not matter to the traffic growth at all. And which means my yields are holding up, my earnings are holding up, and the valuations are still about, you're looking at cash flow yields about 8 or 9% for something like SpiceJet, something about in the region of 6-7% for Indigo. So it's a great sector to be in. at least over the next 2 or 3 years.
The consensus investment theme that we speak to or interact with a lot of analysts, they talk about the rural growth. Are you playing this story?
So we did some very interesting work on the rural growth, and I think that this narrative actually started after perceptive poor rural performance of BJP in Gujarat, which I don't necessarily subscribe to, and anyway now Northeast tells you that it is far beyond that. It is far more challenging. Just because you believe that government needs to pump up the rural growth, it doesn't happen. The only thing that you've got in your hand is essentially MSP price increases. Mm-hmm. That is a very small part of the farmer's income, right? So you need to have far more rural activity. As a matter of fact, we've done some work on the investment sides, and they will come as a surprise to you. So the common narrative is that investments are not picking up, which they are not. But the biggest negative delta hit to investments in the last 5 years has been residential real estate. Everything else has been flat. So my investments are decreasing, my private capacity is decreasing, but as a percentage of investment, that is flat. What is given away is residential real estate. Again, more numbers, but it will give you a perspective. So if you look at from 2004 to 2012, the farm labor lost about 38 million guys, which is that you migrate out of farm and get into ancillary activities, right? 70% or 28 million jobs were created in construction. That construction activity in the last 3 years is declining by 4%. The entire narrative of poor job losses is real estate and construction, and I think the government needs to get that right. You cannot grow at 9%, 9.5% if you cannot get real estate right.
But there was so much of thrust going for affordable housing for all, by 2022. So that work is not happening, you're saying?
No, it's happening. But the fact of the matter is that you are trying to improve things at the bottom of the pyramid, and it looks like that will certainly happen. But then you have taken away the interest rate benefits at the premium end, which is the interest savings for the second house purchase. Now those are 5 crore properties, so you'll have to sell one property over here and 500 properties over there. So that rebalancing is happening. Net I think is not adding any delta to the overall growth rates. So I think that you'll have to look at a lot of bottom-up stories other than saying that you need to get very excited about rural growth or something like that. I don't buy that story.
Well, let's hope it works out sooner rather than later. But Nirav Sheth, thank you so much for taking the time on and speaking with us today on Bloomberg. Sure. Always appreciate your time.
Pleasure to be here.